Hello everyone. Today's topic is basic of derivatives. In the part first, in Indian equity derivative market, the brief history. The brief history in May 2000. I am explaining last lectures. How can the derivative market launch? Today we can study the main features of derivative market. The Prime Minister, Premium Exchange. The main premium exchange is National Stock of India Limited, NSE, the stock exchange in Mumbai. BSE, it's called Bombay Stock Exchange. Then almost all transaction drive segment extend on NSE. The main transaction done under almost the transaction derivative segment in existing on NSE, National Stock Exchange. The trading system, full automated, screen-based, and order derivative system. It means dematerialized. Order are matched on price time period. When time period आधीच मी सांगितलंय डेरिव्हेटिव्ह मार्केट इज टू टाइम पिरियड आहे फ्युचर आहे अँड स्पॉट टाइम पिरियड आहे इधर हियर इज टू बोथ time period are work. Then contract are cash settled. So both contract are cash settled. Cash settled means settlement price system. Okay, you have paid your cash and done your work. The trade are marginable. Unlike in equity segment, where is the institutional trading are margin expected. Dri- Derivatives volume is more than double the derivative volume. Means तुम्हाला किती ड्राइव करायचं आहे is always double to equity segment. Means this deposit in equity capital or etc. The primarily due to the lack of alternate inviable product for short selling time. In the short selling and carry out the forward of trading equity segment and also meaning of derivatives. So what is derivative? The derivative is a product whose volume is derived from the volume of underlying asset. It means if you want furniture, then woods are compulsory. If you want best food, then groceries are compulsory. It means the derivative of a product अशी वस्तू जी दुसऱ्या वस्तूवर निर्भर असते आणि त्याने आपल्याला पैसा बनवतो. It is derivative. Underlying assets can be equity, forex, commodity, and other assets. For example, Sensex and Nifty. Sensex and Nifty, what are they doing of Sensex and Nifty? That both are doing the selling of assets like equity capital, debenture, etc., which is under also demat account, which is under also dematerialization, which is under also आणखी कोणाच्या अंडर आहे ते तर आणखी आहे ते ह्याच्या अंडर आपल्या SEBI. That SEBI is main making rule for Sensex and Nifty, and Nifty Sensex and Nifty makes rule for or holder equity holders. An equity holder done and sell and buy the equities under that work. Function of derivative. First, price discovery. Derivative market like National Stock Exchange, um, Bombay Stock Exchange, and other stock exchange. For the stock exchange, another commodity exchange, like for exchange of commodity. Here, the main thing is the price is discoverable because the goods are sell at a rate of similar to anyone. The person is richer or not. Then risk transfer. If the price is discovered, then you know that your person is capability, buying capability and all. Then you transfer the risk and all and easily record it. Then high volume. The high volume profit is here where the rate are done. The rate are done, the work are done, then your risk volume of profitability is high. Control specialization and enhance enterprisation. Then type of derivatives. The first type is forward and second type is future. I I also explained about that in last lecture. Today I am explain further it. Forward. A forward contract is a customized agreement between two parties to exchange as an assets written period in future at today pre-agreement. म्हणजे आज जो एग्रीमेंट होतो की तुला ह्या दिवशी हे भेटेल, इट्स फॉरवर्ड. हे फॉरवर्ड करतो आम्ही, टाइम फॉरवर्ड करतो. इट्स अ फॉरवर्ड कॉन्ट्रॅक्ट. इन फ्युचर कॉन्ट्रॅक्ट मीन्स भेटेल, इज डिपेंडिंग ऑन युअर वर्क, म्हणजे इज ग्रॉसरी अँड ऑल. Aggregate. Agriculture, non-agriculture. The agriculture contract, a future contract is agreement between two parties in exchanging asset and creating date and creating price. म्हणजे एक थोडक्या वेळात किंवा थोडक्या टाइमिंग मध्ये थोडक्या किमतीमध्ये जी काय होणार आहे, इट्स अ फ्युचर कॉन्ट्रॅक्ट. फ्युचर कॉन्ट्रॅक्ट स्टँडर्डाइज फॉरवर्ड कॉन्ट्रॅक्ट ॲज अ ट्रेड अँड एक्सचेंज दॅन ऑप्शन कॉन्ट्रॅक्ट. इथे तुम्हाला ऑप्शन दिलं जातं टू बाय, टू राईट, टू नॉट, ऑब्लिगेन्स बाय, टू सेल, इट्स फिक्शन specified underline at the set of price and all. Participation in derivatives. Hedger. The first participant is hedger. Hedger pays risk associated with price and assets they know. Hedger काय करतो तो risk associate करतो, face करतो. The person is investor. The person is investor. They use the derivatives to reduce to elimination risk. Derivatives means different number of risk derivative use करतो. Some investment in share, then some investment in debenture. म्हणजे इकडून लॉस झालं तर इकडून आपण थोडं प्रॉफिट घेऊन इट्स कॅपेबल टू इक्वलाइट इट. Then specular. Specular but or not a future movement in the price of asset. Derivative give them extra leverage by which them in increasing both the potential given losses. Aggregator. Aggregator takes advantage of discrepancy between the price in two different markets. Development of exchange trade financing derivatives. Increase vocability. कसं डेव्हलप केलं? The first one is increasing volatility, integration of market, better communication facility, specialization of risk management, innovation in derivatives. Introduction of forwards. Then forward म्हणजे काय आहे? The forward contract. A forward contract is a customized agreement between two parties. Exchange and assets at the created period in future at a two-day price per agreement. For example, on May 1st, 2004, Mr. X agreed to buy 10 toll of gold, 10 tola gold from Mr. Y on December 31st, 2004 at the rate of 65,000 per tola. Mr. X has taken a long position and Mr. Y is short. On the other detail, the negotiability is here. On May 2001, the rate of gold is different. On December 31st, 2004, the rate of gold is different. But in introduction, it's forward contract. Contract is done here, but is there the on 1st May rate is conducting here. Negotiability is here. Silent features. Bilateral contract. The forward contract and bilateral contract. Customized agreement means written in customized agreement मध्ये चेंज करू शकताय तुम्ही. Price known only as the participating derivative setter, revival supplier and all. Users, forex and speculator. Limitation, lack of currency, certainty of tradition, illiquidity and counter to party risk. They are the limitation. Then future contract. Future we are designing to solve the problem that existing in the forward contract. In future contract is an agreement between two parties to exchange an asset and creating it. Future contract are the standardized forward contract at the trade on an exchange. To facilities liquidity exchange, specialization, standard, future and contract, continuity and continue underline. Date, month or delivery are fixed until the price, quantity and minimum price change, location, mode, settlement. They are the features of future contract. The terminology, spot price is here. Price which an asset trade in a spot market is done. In future price which future contract trade in a future market, it also done because it is agreemental contract. Contract cycle, period over which contract trade derivatives contracts have 1 to 2 or 3 month expire cycle. How much? Maximum 3 month expire cycle. Expire date are specially derived from the contract. It is less than Thursday, last Thursday, and at last day for the contract be trade. Contract will be case in existing from this day. Contract size, quantity of assets that has been delivered under the contract is depending on new basis is different between future and spot. Theoretically basis is always in positive. Cost of carry, it's measure the interest cost that is the paid of finance that assets less than income can earn on that cost. Initial margin, amount that must be deposited in the margin account in order initial and future position. Margin, uh, then market to market margin in future at the end of each tradability. The margin account is adjusted to reflect the investor gain or loss. It depend on upon the future closing price and adjusted the call of market to market margin. For example, Mr. X buy the Nifty future at 13,000. On one day, 1310 closing rate. Second day, it's a 1305, and third day, the 1315. The total is 15. The margin 20 cost is 15. In simple example, I can explain. Then maintenance margin. This is a lower than the initial margin. Maintenance margin is lower than initial margin. For example, here the margin is 10. The margin is 10. My minimum 10 margin is here. But the lower range is -5. Means 5 कमी पण होऊ शकते किंवा 5 वाढू पण शकते. But the minimum 10 तर आले पाहिजे. This margin is set increase that the balance in the margin account never become negative. कधी बॅलन्स अकाउंटला निगेटिव्ह करणार नाही. फॉर एक्झाम्पल 5 ने कमी झालं तर 5 पॉझिटिव्ह इज देअर. ओके. इफ द बॅलन्स फॉल्स बिलो मेंटेन मार्जिन कॉल इज मेड. या फॉल्स बिलो होतो म्हणजे जिथून खाली व्हायला लागतं इट्स कॉल मार्जिन कॉल. Trade is expected to the top up margin account in initial margin level. Future payoff. A payoff is likely profitable profit or loss that would be accrued to make participation with change in the price of underlying asset. Future have is a liner payoff that is the losses as well as profit of the trade-off future contract unlimited. Who is the future buyer? The Mr. buy the Nifty future at 1250. The first Nifty is at a payoff is 1000 rupees. Then payoff is -250 because 250 rupees is future payoff. If today Nifty is 1100, then payoff amount is and upper payoff amount is 150 rupees. It is a future payoff means पुढे किती असेल आणि आता आपण किती पे करतोय त्या पेऑफच्या हिशोबाने जे कॅल्क्युलेशन होणार आहे. For example, today Nifty is 1400 and the payoff is -150. Positive payoff yield 150 here. Then selling payoff is similar like this. Here, if future Nifty future is 1250 and your pay 1000, you getting the positive 250 payoff is for you. सेल केला 250 तुम्हाला भेटणार. जर आता तुम्ही 1100 ने घेताय आणि 1200 ने फ्युचर पे ऑफ आहे तर 150 रुपये तुम्हाला भेटणार ॲज अ प्रॉफिट फ्युचर पे ऑफ प्रॉफिट. ओके. द फ्युचर प्राइसिंग in equation terminology, future pricing is F equal to S plus C equal to S standard price 1 plus R raised to T, where F is a future price, S is a spot price, C is the cost of carry, R is the rate of interest, T is the time of expirancy. For example, spot Nifty is 1250. For example, स्पोर्ट निफ्टी इज 1250. जसं की आपण इथे घेतलेलं आहे 1250. ओके, याच्यावरूनच एक कॅल्क्युलेशन घेतोय. Interest rate is 10% and time experiment is 1 month. Then the calculation is F equal to S into bracket 1 plus R raised to T. So 1250 plus 1 plus 0.10 means 10 upon 100. 10%, 10 upon 100 raised to 1 upon 12. And the answer is 1260. The future of uses of future. In time of hedging, expose of exposed to future restriction stock, arbitrage and reverse arbitrage, cash of management, leverages directed and trading. Then what is hedging? It is a mechanism to reduce the price risk by taking an opposite position in future market. Equity investment of US dollar in a billion. Then hedging can be entitled by the selling nifty. Future hedging can be for 20, 50 or 100% based on view. Ideally 25 to 35% hedging kept all time, then based on view is increasing decreasing. Is a mechanism to reduce the price risk by taking the options for in future market. Some options like if it can be deposited in a share market, it can be invested in a derivative market, it can be divided in commodity market, it can be invested. No one can have. Hedging on scrap. Also, Mr. X takes scrap hedging. Mr. X take up the rupees 10 nm long position in IPCL on May 1st, 2014. The take short position IPCL future of 10 nm. Expose arbitrage and reveal arbitrage. Future price is always SPOD to spot reading of the spread through the arbitrages or reveal arbitrages opportunity, providing for the risk-free return. Modes of arbitrage: leading funds to the market and leading security to the market. The leading funds to the market. Follow up a plan. Before the expiry of month future contract, the difference between spot price and future price narrow down to trade is partly unweights the price. For example, ABC spot price is the expiry day is 110 and selling the stock at a 12% more. Then the range of the 12% is leading fund market price. Then leading security to the market. Here, the same position of leading fund, the difference between its spot price and future price narrow down the trade parity. Cost involved. Brokerage. Equity is 0.5%, future is 5%. The calculation is cash management. During the redemption, measure of during the time of tie, the cash position equity and position can be shifted in future. By doing the sum expose in maintaining at all some small narration, rushing must as needed cash. Cash management is a work of hedging to investing in different form, and the investment of different form is used for the use of a needed cash. Then exposing. The exposing can be invited the future before the actual fresh fund infalls. Exposing means the opening of closing balance, uh, become a brought down, make a brought down, then use it, and also actual fund, new fund are invest there. Opportunity to miss the market move up. Leverages directly trading. The trade use short-term view on the market or single stock based on budget, corporation number, economic refers, participation, seniority, unfortunately, event, etc. via future. If you believe that If you believe that you are active in equity in going to important the price, then it is won't be taking an unfair expose in future part. This can be lead the generation of incremental return. Specialization. Uh, Speculation using the inductive future view on the market based budget overview, corporation number, economic reports, political stability, and forensic event. It means the diversification in your investment. Advantage and disadvantage in the stock of futures. The advantage is leverages and low transfer. But disadvantage MTM debited means marketable trading movement are debited and no ownership. On expiry of service, revolve then the next month. Shift to the future position equity. Let's future is position and expire maybe. Revolve on the next month means आज करू की उद्या करू वगैरह in next month वर transfer केलं. Shift to the future position are shifted and let future position is expire all time expire होतं because your time lag is high then work is high. Options. Hyundai is a launching. For example, Hyundai is launching a Sonata car. Price is 15 lakh. You can book a car paying rupees 50,000. By book the car, what you buy, you can buy not. You just booking. When booking the major can Hyundai force you can buy Sonata. Can you buy? Can you force the Hyundai to sell Sonata? Introduction. An option contract give the buyer that right but not the obligations to buy or sell, especially under the set of price before the specification, car purchase or insurance. Option terminology. Index the option having the index as the underlying the stock options have stock underlying the option buyer buy the option paying premium and get the right exchange in on writer or seller. Option seller or writers that the option to receive the premium and hence under the obligation. Option premium. Price paid by the buyer to seller at occurrence the right compress integration value to time. It's called option premium, expire date and all. Call option. A call option is given the right to buy speculation quantity of the underlying asset at the set of strike price on brief of expiry date. Before the expiry date. The call option means the options that you can call to your seller before expiry date. The seller, however, has the obligation to sell the underlying asset before the experience of good. Buying of call option. Buying on the month of Nifty call with the strike is rupees 1250, premium is 100 rupees. Put the option buyer. A put option give is buyer is right to sell the special quantity of the underlying asset as the set or strike price or the brief expiry date. The seller, however, has the obligation to buy the underlying asset in if buyer of the put option decided and expire on sale.